Hi grade 12s, I hope that you are well. So today I'm going to be moving on and talking about companies, analysis of published financial statements, which basically sort of is a overlap into companies analysis and interpretation, which we did in the previous videos. So I'm basically going to continue with telling you about the ratios, what they mean, what to look out for, what an increase means, a decrease mean, what your answers should show you and tell you about the business, right? So we last spoke about liquidity and profitability indicators. Now we're going to get into solvency indicators, right? So as you can see on my board, the solvency ratio, right? Obviously the ratio, so it is in this format. Always remember the format is very important. And so it indicates whether or not your business can meet or pay its liabilities, and a business is solvent if its assets exceed its liabilities. So on the side, quickly, I'm going to just remind you of this, right? We know about this, the accounting equation. And I said that this side has to balance with this side. And so obviously if you're saying that a business is solvent or considered solvent if the assets are higher than the liabilities, right? This shows that you're solvent, right? Cool. And then we're going to also, in solvency, the other ratio that is used is net asset value, but we're going to discuss it more in returns, right? And then this asset value is valued in cents, and it's also called NAV from time to time. So let's move on to return, right? So return, we're going to deal with the first ratio or the first indicator, which is the return on shareholders' equity. I just abbreviated that. I hope you can see that. So the return on shareholders' equity. It indicates that the return that the owners have received on their investment in the business, right? And it should the owners rather have invested elsewhere. So it basically just answers all the questions that owners should have. Are we getting what we expected? Should I have put my money somewhere else, right? And you compare it to the returns achieved in other financial institutions. Okay, so basically this is a ratio or a measure that you would use when they ask you if this investment was worth a specific shareholder's time or money or investment, right? And it is in percentage. Okay, then we move on to earnings per share or EPS. That's usually what they call it when they ask you questions about it. It is measured in cents, so X cents. And it is to establish if the purchasing of shares was worthwhile or not, right? And also whether or not the company has long-term sustainability and growth potential. So all of this return has to do with, as the person who put money into this business, am I seeing what I'm supposed to see? And is it giving what it's supposed to give? Okay, and so yeah, it's measured in cents. Then dividends per share, right? Dividends per share is earnings are distributed to shareholders as dividends, but some earnings are retained to ensure future growth. So this is just to measure the dividends that they get and if they are worth what they put in. This is also measured in cents, right? Then I said we're going to focus more. Oh, my bad, guys. You guys can't see this whole time. My bad. So it is also used to measure dividends, right? Then the net asset value, NAV. I told you that it was going to overlap from insolvency and then come to return, right? And this represents the eccentric value of the share, a more realistic value based on the performance of the undertaking over the years and the growth of the business, including a acquisition of assets and additional shares being issued. So in terms of return, this looks into the net asset value of the shares, right? And like I said, the more realistic value based on the performance of the business. And then in terms of solvency as well, it just talks of the net asset value in terms of, can we then do are we solvent when we're looking in our net asset value, right? And the net asset value, like I said, is valued in cents. Then the next ratio we should look into is risk and gearing, right? And risk and gearing is basically divided into two ratios, right? And you know ratios is put in the form x is to y, right? The first one we're going to look into is the debt equity ratio, and this is a gearing ratio. The debt equity ratios comes with a lot, right? So it proves insight into capital structure of the business. A ratio of, okay, let me just use this space to do the example. So a ratio of 0.52 is to 1 indicates that for every 1 rand of capital that is invested by shareholders, 52 cents is raised through long-term loans, right? It also indicates that the ability of the business to raise additional capital through long-term loan is either favorable or unfavorable. And then a lower ratio indicates that the business has higher credit worthiness, that it should therefore be able to obtain additional financing easily. Then it is favorable for the business to make use of borrowing capital when interest rates are lower than the return that can be earned by the business in using those funds, right? So that is a summary of debt equity ratio. Then we move on to return on total capital employed, and this is a percentage, very, very important, we know this. And it is used to compare the figure to last year and whether it is improved or deteriorated, right? So we compare the total capital employed of this year to the total capital employed of that last year to figure out whether it has improved or deteriorated, right? And if it is above or below the interest rate on loans, and if it is above, it indicates that there's positive gearing, therefore it is favorable to use loans. Oh, my bad. And if it is below, it indicates negative gearing, and that therefore it is unfavorable to use loans, and the business should consider paying off loans quickly, right? So risk and gearing basically discusses, is this a risky decision to make? Is it a smart decision to make? And these are the two ways in which we can measure these. In the next videos, I will then show you examples, formulas, and the rest. But this information, like I said in the previous videos of the last lesson, is that this information is important because it helps you answer the questions that you're going to be asked, and it also helps you understand why we have solvency ratios, risk and gearing ratios, and the rest. So other than that, I hope this helped you, and I hope that this will help your studying process, and good luck with your exams further. Bye.